Hello and welcome to the Honolulu Hawaii Housing Report. I'm Patrick ONeill, Principal Broker Owner at Luxury Homes International. And with me today is the Principal of TZ Economics and Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, good to see you.
Mele Kalikimaka, Patrick.
Thank you. I suspect it's been a busy week for an economist. The latest inflation figures were released, the Fed board meeting yesterday, and they also released their economic projections.
Yes.
There's been some substantial movement in the mortgage interest rate market and some, quite frankly, shocking figures in the housing numbers. Why don't we start with inflation and the Fed meeting?
Sure.
The CPI index was released at 7.1, down slightly from the month before, down quite a bit compared to last year. We were at 9.1. At the Fed meeting yesterday, they increased their Fed rate half a percentage, which is not really a surprise. The comments afterwards were taken by some as a surprise, and the fact that the Fed would continue to be aggressive into 2023 and acknowledge it would cause a more economic pain. Paul, from your perspective, what did we learn from the CPI index numbers and also the Fed's actions and comments yesterday?
Nothing at all.
Okay, all right.
If you've been paying attention and actually listening to Jay Powell, and by the way, you can actually go listen to Jay Powell. You can just go to YouTube and go listen to his press conference because it's really instructive. And then you don't have to listen to all the clowns that are trying to reinterpret what he said. Now, to be sure, the best 30 or 40 financial economics reporters are in that room at the time of the press conference. So I don't mean to suggest that they're unprofessional by any means. They're really they're all kids now, but they're all really, really top-notch people. They ask good questions. So it's really worth just listening to that conversation. But yeah, no surprises. Inflation's doing exactly what I thought. The Fed's doing exactly what I thought. It's the other thing. Powell gives us enough forward guidance that is, I don't know how anybody could be surprised at this point about what they're doing. So it's more follow through on what they said was going to happen than a change in course. And if anything, the takeaway that maybe they're being more hard ass, is a realization by some that they should be taking this seriously. Still, as Powell said yesterday, nobody knows if there's going to be a recession. There's, to me, the odds are 50-50 and we could actually come through with a soft landing. But did you want to talk about the detail or that was my takeaway? Yeah.
Yeah, and let me ask you kind of in the macro picture. So you're thinking still at this point, soft landing, so to speak, is still possible.
I got a shot. We've got a shot at it.
We've got a shot. More than likely, we're going to hit some pretty hard times. I mean, even Powell used the word more economic pain to come.
Well, recession means going backwards, right? You could just come to a full stop, and that would be painful because everybody seems to be rolling along outside the housing market. And of course, that the Fed meant to do that. And sadly, for the housing market, it's about the only channel effectively through which they can exert an influence, given that the inflation we're talking about isn't even primarily coming from the housing market. They're trying to preempt what may come, but the housing market is going to do that by itself anyway. But there's nothing the Fed can do about the Russian invasion of Ukraine or the legacy of the federal fiscal stimuli, the fact that state governments are still spending COVID relief money. Okay. I mean, seriously, now you're going to spend the money. Where were you 2 years ago when we needed this support in the economy? So I just got an email yesterday that said, the last thing Governor Ige did was release 400 million in public works spending. It's like, well, what the hell were you 2 years ago?
Right. And so,
right.
And Paul, if
we have inflation now you're going to spend an extra 400
right
million. What's the plan?
And if I recall, the target rate for the Fed, target rate long term, is around 2%. Is that correct?
Well, the target rate for the inflation
rate,
the inflation rate is 2%. And that's measured by the personal consumption expenditure. And what we tend to track is instead the consumer price index. It's measured differently, tends to run a little hotter. So the 2% goal of the Federal Reserve would track to something more like 2.5% if you measured it with the Honolulu CPI, which is my entree to just show you the data here. Why are we even
Okay.
talking about it?
All
Let's
right.
just look
Let's
at the
see it.
data.
All
And you
right.
can see the shaded area is where the pandemic hit, and then we had fiscal stimuli bookended by the CARES Act in March 2020 and the ARPA, the Trump and the Biden fiscal stimuli and COVID relief measures as bookends on this period of stimulus. And right after, and of course, vaccines were rolling out in 2021. And so the combination of reopening the economy and then fiscal stimulus and low interest rates, as we know, if you remember the housing market only a year and a half ago, was this huge boom that turned inflationary, partly because the factories and the container ships and the supply chain that ordinarily would have been going full tilt and could respond to the increase in aggregate demand was all jammed up by the pandemic, or was having trouble getting restarted because of the pandemic. And that meant that there was in the absence of a sufficiently responsive production and distribution, transportation response, the increase in demand partly went into higher prices. And that's that first inflation spike you see there in the Honolulu CPI. Then Russia invaded Ukraine this year. And so we had another surge of mostly energy related inflation. When you break down the inflation statistics, part of it is coming from petroleum because of the invasion. Part of it's coming from food, a lot of which is just grain because Ukraine is the fourth largest wheat producer in the world. And but now you can see it's burning off, and it's burning off rather quickly. So your question is, when do we get back to the 2%, which is actually 2.5% measured by the CPI? And my guess is we could be there by the end of next year. This is a highly volatile data set. Hawaii's data are published bi-monthly, and I've annualized them to give you a feel. We had deflation in Hawaii this fall. Let me say that again. The price level in Hawaii was already falling this fall. That was not
must
in the
be
news.
Something that excludes food and energy, because those certainly increased.
Well, I don't know about you, but
yeah,
petroleum's been falling, right? Petroleum peaked at $120 a barrel last year. Where is it today? $78 a barrel, $80 a barrel. So petroleum prices have fallen by a third in the last 9 months. And in fact, the peak for inflation in Honolulu in these Hawaii data was last March. It's December. So maybe we can get over the inflation thing because it's already over. It's in Hawaii, it's already turned deflationary, not just disinflationary, which is lower inflation, negative inflation. Now, that's a one-time thing. And you can see we had one of those in 2014. Why? OPEC couldn't keep all the oil that Canadians and Dakotans were pushing because of fracking and horizontal drilling back in 2014, and the price of oil collapsed. The price of oil has collapsed since the Russian invasion. And so we're seeing some of that show up in gasoline prices, maybe not food. But the point is the disinflation the Fed's been looking for is already coming. So in retrospect, right, in the broad sweep of history, going back to World War II, what we've been through recently is more of a one-time inflation spike because of the pandemic, right? It's the pandemic, stupid. Well, it's a one-time shock, the legacy of the pandemic, and the Russian invasion of Ukraine, and now it's burning off. And it's more like the inflation we saw in the mid-20th century, where you had war, and then another war, and then demobilization from the war. And then talk about the supply chain being jammed up. How about the dock workers going on strike for 6 months? That happened in 1949. So we've had more of one of those kinds of events. And the one the Fed is working really hard to preempt, which is one in which inflation expectations crescendo, like those wedges I show there in the 1960s and 70s, in the 1980s, and in the early 2000s with the subprime bubble. And so far, I think they've succeeded. As you say, people take Jay Powell seriously. What the takeaway in the media is, wow, that guy's a hard ass. And I'm sorry, the inflation today, which in Hawaii is not 7.1%, is 5.8%, is also not the highest in 40 years, which I'm sure you heard multiple times in the media yesterday. Oh, we're trying to deal with the highest inflation in 40 years, except it's not, and it's deflation in Hawaii. But okay, fine. I get your point. Take a chill
Yeah.
pill,
Well,
wait a year.
that's why we come to you to get what it is.
And what's
And
important for housing
yes,
is it means just as quickly as, the Fed shut the front door on the housing market, right? That happened this year, going from a 3% mortgage to a 7% mortgage happened in the same 9 months that the
right.
inflation rate in Honolulu went from 7.5% to 6%.
Well, let me ask you this question then. Where would the CPI index number be where the Fed says, you know what, I think we won. We don't need to hold these high rates any longer. Is there a number?
Listen to the press conference, go to YouTube or go to
I'd rather just
federalreserve.org.
ask you.
My point is, Jay Powell was asked precisely that question, and he said, it's data driven, it's data dependent. We don't, there's no rule that says once we get to 3.379, then we stop, right? It's a question of how much momentum there is and what else is going on in the economy, and did Russia invade anybody else, et cetera, et cetera. But
I got you.
if
Okay.
two is the number and the number is two,
Numbers two.
and the U.S. is the which is 2.5 for the CPI, and the U.S. CPI is at 7.7. There's 5 percentage points, roughly 2.5. Call it 7.5, 7.1 actually yesterday. My bad. Call it 5 percentage points to go, half of which are coming from the supply side, from the Russian invasion, from the shortage of harvest failures and whatever else is going on the supply side of the economy. And the other half is from the demand side, which the Fed is crushing with high interest rates. So
Yes.
high at six. We've talked about this before. At $6.50 a bushel of corn, up from $3.50 a bushel of corn, right? One day you're a farmer in Iowa a year ago, and the price of corn is $3.50, or 2 years ago, and now it's $6.50. You better plant some corn, bro. But wait, it's December. You can't plant corn until April. And so these things take time in the commodity space. In the case
Yes.
of a factory, maybe you could just dial up the factory and load up the container ship. Now that the backlog of trans-Pacific shipping and mooring capabilities in the U.S. West Coast has been cleared up. That backlog was a big problem a year ago. It's on now.
Okay, well, let's look. You brought up the mortgage interest rates,
Yeah,
and actually some really good news this past week. We
right.
had peaked over 7%.
Mm-hmm,
This is the Freddie Mac data, actually this morning. So 6.3 for a 30-year fix. This is
mm-hmm.
just looking at where we came from this past year, as you mentioned before.
Yeah,
We were sub threes, went over 7, but now it seems like a little bit of retracement in that rate. When we look at a little bit longer screenshot, this is over a 10-year period. Obviously,
mm-hmm.
we're way above where we were. When we look at it going back to 1972, where do you see us on this, where this will stabilize? I think you mentioned in the past maybe around 6%, 5.5. Where do you think we'll stabilize on interest rates?
Yeah. What's important about this graph we're looking at right now is how different what's happened in the last 12 months is from anything that's happened in the last 40 years, right? Interest rates matter. Interest rates go up and down, but they don't go up like they did this year, except under extreme circumstances like the inflationary period in the late 1970s, which the Federal Reserve intervened to quash with high interest rates. So now, is what we're going through the same as what we went through 40 years ago? Hell no. Look at the numbers. You think 7% is bad? How about 18% for a 30-year fixed rate mortgage? So all these people say, "Oh, it's just like 40 years ago." No, it's nothing like 40 years ago. But what is like the last time we went through this is how abrupt and how much of an increase in mortgage rates occurred in a very short period of time, literally within 1 year. But what that also suggests, and you showed it in your last slide, people are already realizing that it overshot, right? It was like people freaked out. They overreacted. The mortgage rate went to 77%, which was too high, because when you look at today's 10-year government bond yield, which is out of focus, but is 3.5% or so, 3.45%. Call it 3.5, add 175 basis points of credit risk premium associated with mortgage lending. And that gets you to 5.25. Did I get that math right? 3.5 plus 175 basis points is 5.25. So for the 30-year fixed rate mortgage, that would suggest that there's another 100 basis points, another full percentage point of retracement from 7%, where it's 6.25, 6 1/3, another 100 basis points to unfold over the next year if it takes a year. And I think it'll take a year or more, 18 months, for the Fed to get to the point you just asked about, the moment where they think that they can begin to back off.
Yes. Well, it's good news, certainly for the housing market. Paul, we're going to take a quick break. When we come back, let's jump into the housing statistics. And I think there's some kind of shocking numbers there. So stand by. We'll be right back with economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker and the Honolulu Housing Report. By the way, if you're enjoying this material, please give Paul a thumbs up down below. He'd really appreciate that. And subscribe to this channel. Make sure you don't miss next month's report. So, Paul, we're going to jump into the housing information. This is the latest report from the Honolulu Board of Realtors. And there's a couple of dramatic things I think we need to talk about and touch on. Number one, closed sales for single family homes is off almost 50% and over 40% for condos. That is really dramatic. And obviously that's related to the interest rate spikes, right?
That's a shellacking. Absolutely. Pending sales, same thing.
Yeah, so we'll look at that in a moment. Closed sales, if we look at this, we're hitting less single family sales than we have through the whole pandemic, through this whole spike. And even post-pandemic, we can see condos are trending down here as well. This will probably continue, won't it, until we see some rise or some decrease in the interest rates?
I guess. Well, the real question is whether in 2023 it turns around, and by how much, because going from 3 to 7% mortgage interest rates, right? That's clearly what's showing up in the data now. But going from 7% to 6.3%, that's reopening the opportunity for somebody who's really desperate and needs to finance. And then, as I said earlier, I think if we end up in a 5 to 5.5% range is, the settling point, say a year from now, or in 2024, that's not bad money, considering it's not going back to 3%. That's the other thing. You can't use you can't use the pandemic intervention as a guide to what normality will be at the end of this Fed tightening. Normalization is going back to 2% inflation, a reasonable employment growth rate with reasonably full employment, and a mortgage interest rate that's closer to 5% than 3 or 7.
Well, let's continue, and we'll come off of this and take a look at active inventory, another very dramatic number. Single family homes up 86%. I don't think I've ever seen it that large. Condos up 20%.
It's just the pileup you get. Somebody turned off the light switch, and there you go. Now things are piling up.
Yeah, and if we look, this is what's kind of interesting at the same time. We're still below pre-pandemic inventory levels, both condos and single family homes. Certainly they're trending up, but we have a ways to go. And let's look at, if we put these two statistics together, how dramatic
you got to remember that the active inventory, you can think of it as kind of as the supply side, one version of the supply side. And why would you list your home right now? You know what I mean? You as a seller are probably also going to wait if you have the choice, right? Maybe you have to move for a new job, but if you can wait until a year from now when the mortgage rate is closer to 5% than 6 or 7, given where prices got to, it might be worth waiting. And I imagine it's not just on demand side of the market, but also on the supply side market that people are.
Yeah. And
are
last month, I'll point out 46% of single family homes, 36% of condos had a price adjustment to the list price. Anecdotally, if we look at neighborhoods, buildings, certainly the prices are coming down. There's no doubt. So we're
Yeah, oh
seeing the
yeah,
build
sure.
up. So yeah, I mean, this is sort of the demonstration looking at these two dramatic numbers, closed sales, inventory, um, piling up. It's just supply and demand.
Yeah,
And so right now, I know it's kind of hard to think of it this way, but maybe a year from now, we see mortgage rates starting to stabilize in that mid 5, low 5 range.
could
And
be.
then
Yeah.
now we start to come back some equilibrium.
Let me. Can I jump in and show you
Absolutely.
a somewhat harder to interpret, but I think worthwhile exercise in thinking about that timetable to which you just alluded. So here's what we've been on the right side of the screen. That inverted U-shaped arc is where we were when you get to a 3% mortgage rate. That's May 2020. Get to a 3% mortgage rate, sales explode. They go straight up. They go from 240 single family sales on Oahu every month to 380, let's say. And then as mortgage rates go up from 3 to 7%, you see that downward slide. And the question now is, we've just done the inverted U, the upside down U-shaped part of the cycle. When do we do the U-shaped part? And what does that look like? Well, it's on the left side of the screen. And the last time we did this was back in, the last recession. And this ellipse I've drawn around, if you remember, I've showed you these data before. That ellipse is actually the boundary within which 95% of the observations on single family home sales and 30-year fixed rate mortgage rates cluster for the last 20 or 25 years on Oahu. All the data sits inside that egg and kind of goes around and around in this elliptical fashion. Now, last time it took 5 years to get from January 2008 to the spring of 2013, where you might say, well, we've transitioned, we've gone all the way through the U. And I'm thinking where we are as of November last month, and when I made this slide last week, the mortgage rate was 6.5, today it's 6.3. You can already see, you can imagine as you go from 7 to 6 to 5 handles where we could be over the next year. We could be already forming that U, the bottom of the U, the bottom of this is the way I've drawn the cycle here, literally within the next 6 months to a year. And then, maybe we'll stay at 5. Maybe that will be more of the normal.
Yeah. Well, that's certainly good news for everyone in the industry. So Paul, let's take a real quick break. When we come back, let's see what the future holds. We're going to look at pending sales and also a look at home prices.
Okay.
Okay, so don't go away. We'll be right back. Okay, and we're back with economist Paul Brewbaker. And Paul, we're just about to take a look into the future and take a look at the pending sales data from the Honolulu Board of Realtors. We see pending sales. This is the 7th consecutive month, by the way, pending sales have been down. Single family homes, almost 50%, condos, nearly 40%. It just seems like it's going to be the same thing next month. Do you
Well,
agree?
next month for sure. Yeah. I mean, right. If it's fallen, by a third to half in the last 9 months, it's going to take you,
Right. Yeah.
12 months or
Until we
something.
see
That,
movement on
yeah,
the
I mean,
mortgage interest rates, nothing's
it,
really
it,
going to change.
well, even if it stopped falling, it would take a year to get to where you are now on a year-over-year basis. Do you see what I mean?
Yes, I do.
So,
Yeah.
I don't think it'll actually take that long, but the real question for a realtor, for example, is given that we can pretty much think through a very soft winter season, an unseasonably soft winter home buying season, the question really turns to next summer. Will the investor have any appetite? And actually, I'm more ambivalent about that.
Yeah.
something could happen in the stock market, and something's already happening with interest rates,
And I'll
and
tell you,
as
right now with prices coming down, which is supply and demand issue,
yeah,
it
yeah,
it does make it more attractive. And if you come in and get median pricing, this is year over year, single family homes still up 9.5%, condos down slightly. I thought it was interesting to take a look at this compared to where we were last year, where we were double digit in
hmm
both of these,
hmm
heading up. Again, no surprise. I think we're going to see the same types of things. My question is this: why does the median sales price continue to go up when we know, sort of anecdotally and in the market, that prices really are coming down?
think of it this way: is the just looking at the numbers. Well, I'll show you a visualization in a second, but does anybody think that median single family prices should fall below 1 million on Oahu? They're at
If you
1.1, 1.15.
if you're a
Not
buyer, you'd like that, but
You'd
I don't
like
know if
that,
it's
but
going to.
if you're a seller and if you're a potential seller, a prospective seller, and you got kind of interested, in busting a move at 1.2 last summer, 1.25, would you sell for under 1 million? No, you can just stay in your house until things catch up. And with condos, the threshold is probably 500,000. Is it going to go back to 400,000? I don't think so. Well, like I say, I can actually show you on a seasonally adjusted basis what that looks like. The problem with doing year over year estimates is there is seasonal variation in the way the data are actually published. So I remove the seasonality, and then all that's left is kind of a pure trend. And what you see in these two data sets, we talked about this again, like many things, talked about this at length over the last couple of years, because it was so odd that this mini bubble was happening only in the single family housing segment and not in the condo segment. Right now, relative to the path condo valuations were on in the 20 teens, they're fairly valued. They're right around that 5% trajectory that condos experienced in the last decade. And if you think about COVID and its economic disruptions as essentially transitory in nature, they blew things up and everything had to fall back into place. And as often is the case, things fall back in slightly different configuration. More people are working from home, for example, than was the case pre-COVID, and more people will forever work from home. They're not going back to the other. We're at the point now where those people aren't going back to the office. And obviously that affects housing, that affects commercial space, et cetera, et cetera. But now that things are falling back into place, the inflation is coming down. It's already coming down. It's been coming down for 9 months in Hawaii. It's been coming down for 6 months across the US. And in another 6 to 9 to 12 to 18 months, we'll be back in a world where the inflation story is completely gone. The idea of converging back to these trajectories makes a lot of sense. And as you see, even in the single family home market where there was an overshoot, just like there was an overshoot in the mortgage rate more recently, we're not that far from where, the true path is. And the true path is around 1 million at the end of 2023. Hence my rhetorical
Right.
question, would you sell for less than 1 million? Why, when you can wait a year and that would be fair market value?
Yes,
Um,
yes. And we've looked at that chart that you have there several times. The overshoot
yes.
in the single family is noticeable. The other noticeable thing is that the condos really bounced around under trend line.
They got pretty
Um,
weak. Now there are a couple explanations. One of which is the city council's
yeah.
war on undocumented vacation rentals, but I
Mhm.
think that's behind us at this point. Everybody that got scared and bailed out, and sold their Airbnb has probably done the deal, or I hope they did, because now who are they going to sell it to at
Yeah.
6.5, 6.25 mortgage rates? But I think
Yes.
that adjustment is probably done, and
Yeah.
the fire sale is over.
And the overshoot in single family, that starts to reflect now with 86% more inventory on the market and closed sales off 50%.
Well,
So good.
the inventory pileup is going to prevent rapid recovery in the housing market, because first you've got to sort of burn off the inventory, and
Mhm.
people will give up and pull their houses out of the active inventory, and come back later. But all that adjustment has to happen over the next year or two.
Yes,
My
and it's
my
not
my
necessarily a bad thing. I mean, it gives
no,
buyers opportunities that they didn't have previously. So
yeah,
it seems that we went through this shock, as you would say, and now we're just kind of coming back to trend line on the pricing of both of those. So, Paul,
yeah.
let's move into the double bonus lightning round.
Hmm.
And I think I could probably guess some of your answers on these. Okay, so you're so higher, lower, about the same. 1 year from now, inflation
Oh, lower by half. Yeah,
by half. Okay.
yeah.
Mortgage interest rates, higher, lower, about the same a year from now.
Oh, yeah. Another percentage points lower.
Okay. Single family home prices.
Yeah, not higher.
Okay. Maybe about the same, maybe
Maybe,
a little lower.
yeah, maybe a little bit lower. But as I say, I think converging on that path that was going to get us to 1 million by the end of 2023 anyway, the path we were on in the last decade, as it continues through the remainder of the 2020s. And you alluded to this a second ago, but let's make it explicit. This is the moment to begin thinking strategically, because if you've missed the boat before, you don't want to miss it when it comes back into the harbor, which may be
Right.
2023. You see what I mean?
Right. If you're a buyer, it might be ideal. Rates will come down, mortgage rates
Just
will come
pay
down, prices
attention,
will come
because
down. Yes.
waiting till 2026 is going to be too long. Last time, after the Great Recession, you had to wait from 2009. You had to wait till about 2012 before things kind of cleared up. 2013. It's not going to take that long this time.
Yes. Okay. And then last one, higher, lower, about the same. Condo prices 1 year from now.
Oh, higher,
Higher.
a
Okay.
little bit
All
higher.
right.
Yeah.
Okay. Well, you heard it here. Um, Again, if you've enjoyed this presentation today and the information, please give Paul a thumbs up down below. Subscribe to the channel. You won't miss the upcoming housing report. Paul, it's always a pleasure. That's it for us today. Happy holidays to
Happy
everybody. Be
holidays.
safe and aloha.